If you are a new business owner or an entrepreneur needing to raise money for your firm, there are plenty of borrowing options available. Here are a few ways to generate capital for your company.
Welcome to Biz Help for You, the show that saves you the expensive learning curve by providing advice from industry experts in every facet of the entrepreneurial journey. Too many small businesses collapse. According to the U.S. Census Bureau, 20% fail within their first year, and less than 35% make it to their 10th anniversary. The goal of this podcast is to change that statistic. So if you're interested in learning more to be a successful entrepreneur, tune in today.
Welcome to Biz Help for You. Most of the time on my podcast, I'm interviewing guests and sharing their expertise, but today I want to share information with you on possible sources of cash for your business and what you need to do to prepare in order to get the financing you need. If you are a new business owner or an entrepreneur needing to raise money for your firm, there are plenty of borrowing options available. Here are a few ways to generate capital for your company. First of all, your bank. If you have a good relationship with your bank and a solid credit history, taking out a business loan is one of the easiest avenues to improve your cash flow. Banks have their own loan programs, and many offer SBA financing as well. I'll speak more specifically about SBA loans in a few minutes. Note that to get a bank loan, you often need 2 years of business financials and a good credit score. Home equity lines of credit, known as HELOCs. One bank option available is the home equity line of credit, HELOC. This can cover costs of operations or emergency costs, but tread very carefully before committing to this. You could lose your business and your residence. This solution offers a revolving line of credit like a credit card, but your home is the collateral. In actuality, you would be risking your house to pay your business expenses. You may receive a low interest and low monthly payment, lower than a traditional business loan. A change in the interest rate could increase your cost and risk. Consider all other avenues before choosing this option. Lines of credit. Working much like a credit card for your business, lines of credit are indefinite loans of a typically smaller amount when needed. As interest rates tend to be high, use lines of credit as a sort of emergency cash fund to use during times of unreliable cash flow, keeping the business going, or purchasing assets when times are tight. Term loans. Another popular option, particularly for small businesses looking to expand, purchase assets, refinance, or gain capital. Term loans borrow on a timeline, with long-term loans tending to be larger amounts paid off monthly and with lower interest rates than short-term loans. Typically easier for a small business to acquire, term loans can be either secured, if using a particular asset as collateral should the business fail to provide repayment, or unsecured, if the lender approves the loan based off of credit history and reputation alone. Online lenders. If a traditional bank is not the right choice for your business, you may want to look into online lenders, many of which offer loan options for any business owner who qualifies. Not all lenders need a credit check. Some, such as PayPal, base the loan on your sales history and offer repayment terms that are agreeable to your firm. A percentage of each sale that you make will go towards the repayment until the balance is paid. This option is usually pricey, not the first thing you choose. Repaying quickly is the best option to avoid interest. The rates of these loans are high, but they might be better than taking a cash advance on a credit card. Always read the fine print on the contract so that you know what the true costs are. Advances against future sales. This is one method I don't recommend due to high fees and daily payments reducing available cash flow, but I wanted to include it in the discussion as some may find this as the only alternative that they have. An advance from a lender is granted and repaid through a percentage of credit card receipts. Crowdfunding. This method raises money from a large number of investors, usually through the internet. There are two basic types of crowdfunding, which include equity and rewards. I'll include a link to a blog that shares the facts on these options in more detail in the resources page for this episode. Factoring companies. Factoring companies may be a good option if your customers are paying their invoices more slowly, or worse, not at all. Factoring companies can take the work out of chasing down payments by paying you a percentage, usually about 85 to 90% of your invoice up front. After they collect, they give you the remainder of the invoice payment less their fees, which can be up to 2% of the first month and 0.5% more for every 10 days after that. The pros of this include the quick cash influx, the lessening of your workload, and the ability to cherry pick which invoices you would like to have them collect. However, keep in mind that their fees may make a dent in your profit, and sending a third party to collect payments from your customers or clients may damage your relationships. Friends and family. In a pinch, sourcing funding from friends and family could save your venture. While mixing personal and professional can be a tricky business, if you're confident you can repay the loan, you may be able to work out a deal that benefits both parties. Your investors likely already believe in you and your business and have an emotional stake in your success, so you may be able to get more flexible terms with this type of borrowing. In return, you can offer interest on your payments that exceeds the amount of your lender's money that it would make in a savings account. Proceed cautiously and remember to protect your relationship by ironing out the terms ahead of time. Small Business Administration, SBA loans. There are many programs available ranging from real estate to equipment and even disaster loans. There's also a short-term microloan program available up to $50,000. However, these loans are not granted directly by the SBA. Rather, the SBA works with lenders and other partners to guarantee repayment of funds and lessen risk. Understanding and selecting the right SBA loan can initially seem complex due to the 3 loan types, each with its own requirements and restrictions. So let's look in more detail at the types of loans available. SBA 7A loans. The SBA 7A loan program is the most popular, granting over 57,300 loans worth $27.5 billion to small businesses in fiscal year 2023. SBA 504 CDC, Certified Development Companies loans. The 504 CDC loan is ideal for acquiring long-term financing at a fixed rate to purchase fixed assets. These loans are available through nonprofit certified development companies, CDCs. In fiscal year 2023, the SBA's 504 program delivered more than 5,900 fixed-rate loans for equipment, real estate, and debt refinancing worth more than $6.4 billion to small businesses. SBA microloans. The SBA microloan program, facilitated by nonprofit community-based organizations, supports various business needs with loans up to $50,000. In fiscal year 2023, $87 million in microloan funding went to more than 5,500 small businesses. And disaster assistance. In fiscal year 2023, the SBA made changes to maximize its ability to help small businesses and the communities they serve recover and rebuild following federally declared disasters, which resulted in $670 million in relief delivered to more than 5,200 businesses across America. Since the 7A loan is the most popular, let me share more facts about this loan. The SBA 7A loan sounds like one singular loan, but it is actually multiple different types of loans. You can work with a lender to find out which type of loan works best for you and your situation. Once you apply, the lender will submit your loan application to the SBA for approval. Term lengths, interest rates, and maximum loan amounts are dependent on the use of the loan. For example, 25 years for real estate, 10 years for equipment, 10 years for working capital or inventory loans, a possible guarantee fee, which is dependent upon the lender and is a percentage of the loan based on the loan amount. A 7A small loan is capped at $350,000. So how do you know if you're eligible for the 7A loan? A few requirements include that you operate for a profit, are small as defined by the SBA, are engaged in or propose to do business in the United States or its possessions, have reasonable invested equity, use alternative financial resources, including personal assets, before seeking financial assistance, be able to demonstrate a need for the loan proceeds, use the funds for a sound business purpose, not be delinquent on any existing debt obligations to the U.S. government. Specific businesses such as real estate investment firms, religious organizations, and gambling businesses are not eligible for SBA 7A loans. But like most loans and programs, there are always special circumstances that they are willing to take into consideration. Franchises are eligible except when a franchisor retains power to control operations to such an extent as to equate to an employment contract. The franchisee must have the right to profit from efforts commensurate with ownership. Recreational facilities and clubs are eligible if the facilities are open to the general public, or in membership-only situations, membership is not selectively denied or restricted to any particular groups. Farms and agricultural businesses are eligible. Fishing vessels are eligible, but those seeking funds for the construction or reconditioning of vessels with a cargo capacity of 5 tons or more must first request financing from the National Marine Fisheries Service. Privately owned medical facilities. Recovery and nursing homes are also eligible, provided they are licensed by the appropriate government agency and they provide more than room and board. An eligible passive company, EPC, must use loan proceeds to acquire or lease and/or improve or renovate real or personal property that it leases to one or more operating companies and must not make any profit from conducting its activities. And legal aliens are eligible. Applications will not be accepted from firms in which a principal is currently incarcerated, on parole, on probation, or is a defendant in a criminal proceeding. So you may wonder how to go about this process. To do so, you will first want to find an SBA 7A lender. If you do not know where to start with this step, you can look at the SBA website where you can use the lender match tool. Next, you will want to ensure that you have gathered the correct documentation to submit your application. Examples of documentation you will need to provide are the SBA Form 1919 Borrower Information Form, Personal Background and Financial Statement, SBA Forms 912 and 413, Business financial statements such as balance sheets, profit and loss statements, and projected financial statements, business certificate or license, loan application history, income tax returns, resumes for each business owner, business overview and history, and business lease. Your lender should be able to determine if you have the right documentation and will help you through the process, as well as submit the application. The SBA will inform you or your lender of approval within 10 days. The closing process on this loan will require collateral, loan documents, and your authorization. You will receive the funding and follow through on the repayment terms agreed upon. Let's look at a few more pros and cons of SBA loans. A few benefits of the SBA loans include that the SBA loans typically have lower interest, as the SBA sets guidelines for maximum rates. Repayment terms for SBA loans are usually long, ranging from 10 to 25 years, allowing businesses to manage their cash flow effectively. SBA loans can be used for different purposes, providing flexibility in how the funds are used. Down payments for SBA loans are often low, usually around 10% of the loan amount. A few downsides of these types of loans include qualifying for SBA loans can be challenging, as you need a strong business history, good revenue, and excellent personal credit. The application process for SBA loans is lengthy and requires a lot of paperwork. Online applications may not be available, and you might need to visit a bank branch. Collateral may be required for SBA loans, and a personal guarantee is needed from owners with a 20% or higher stake in the business. If after considering the pros and cons, you feel that this is a great option for you, the next step is completing an application. To pursue the SBA loan, you must meet 3 sets of eligibility criteria. The general SBA eligibility requirements, including operating for a profit business in the United States, investing personal assets in the business, and seeking alternative financing sources. Lender-specific eligibility requirements vary among lenders and consider business-related data, collateral, and credit scores. And SBA loan-specific eligibility requirements are unique to each loan type. Banks that participate in SBA loans look for applicants with good credit, a solid business plan, profitable operations, and the ability to repay the loan. Your borrowing history is crucial for the bank when considering your SBA loan application. To begin, contact your bank to see if they offer SBA financing, as it's more likely easier to get funding from a bank where you already have a relationship started. If not, contact the SBA to find financial institutions that they work through to see which might be the right option for you. The process may be long and somewhat tedious, but getting lower interest financing with more time to pay back the principal can help you improve your cash flow for years to come. So, what do you need when applying for an SBA loan? First of all, decide on the loan type. Find lenders offering the chosen loan through the SBA's Lender Match tool. Compare terms and eligibility. Apply through the selected lender. And consider the variety of loan programs and competitive rates. SBA loans can effectively alleviate cash flow issues and help your business achieve its objectives. Now that you know more about the generating funds for your business, consider your options carefully to find the best fit for your needs. So now if you know you are going to secure a loan, what are some of the basics that you need to know? For a lot of people, securing a loan for their business seems like a scary and complicated procedure. You're afraid of rejection or mismanaging the money. Many don't even try, but as it turns out, getting a loan from a bank is easier than you think. What do lenders look for? Are you curious what banking lenders may be looking for your records and how to make yourself seem more reputable? Make sure that you have a good credit history. Maintain a steady, positive cash flow, having more money at the end of each month than you started out with. Follow a business plan, putting your money to good use. Bring in loan documentation, such as business tax returns. Possess collateral like your home, car, or place of business. Have a history of paying debts on time, and you're clear on your clientele value, specifically how much profit they can bring your business. Just like term loans aren't the only option available to businesses, so too are the multiple types of lenders. Take your time, do your research, choose what's best for your business, and if one doesn't work, you can always try another. What are 5 mistakes to avoid? If you want to be approved for a loan, you must make yourself and your business as attractive as possible. Here are 5 mistakes to avoid. Number 1, don't come unprepared. The worst thing you can do is sit down with a banker having no idea what you need, how much, how you'll use the money, and missing the supporting documents. Not only does this instantly show that you don't take things seriously, but loan types and business plans aside, banks can't just take your word for it when you say your business is in good shape. So come prepared. Before approaching a lender, invest in good bookkeeping and ensure your records are accurate and in order. Then, when preparing to sit down with a banker, bring your current financial records with you, along with any other supporting documents such as tax returns. Number 2, don't wait until you're desperate. It may seem counterintuitive, but the worst time to apply for a loan is when you most need it. Banks see desperation for money as a huge warning sign of a failing business, and nobody wants to invest in something that's not going to earn a return. So plan ahead. Look to the future and predict when you'll need the money, then approach your lender long before then, during a month of strong cash flow, when your current financial records show a good profit. Similarly, Don't put yourself in any personal debt, as banks see business and personal accounts as one and the same. Not only will your loan more likely be accepted if you plan ahead, but you can prevent financial disaster should something fall through or a loan take too long to arrive. Number 3, don't be without a plan. Bottom line, if you're asking for money, they're going to want to know what it's for, banks being no exception. Before approving a loan, not only do lenders want to know what it's going to be used for and that it's a good use, but more importantly, that you take things seriously enough to make a plan. So go into depth on how the money will help you expand your business, grow your clientele, refinance, or expand your assets. Chart the logistics and stress the finer points. Forward thinking is a very attractive trait for a banker. Number 4, don't wing repayment. Banks don't give out loans from the kindness of their heart. They're looking for a return. So if a lender asks you how you plan to repay them, make sure you have an answer. Come prepared with long-term cash flow projections, financial statements, and accurate budget reports that detail exactly how you'll not only pay back every penny, plus interest, but in a timely manner too. And number 5, don't forget to do your research. A loan is a big step no matter how you look at it, so make sure it will help your business rather than hurt it. Before approaching a lender, take a look at your profit levels, inventory, expenses, and credit lines, and consider whether a long-term or short-term loan would better suit your needs. Will the loan last as long as the asset you're financing? Can you work with the expenses it might incur? A safe bet is usually to ask for more money than you'll think you'll need. Loans can be a game changer for a business, helping it grow and increase its profits. But if you're not careful, loans can also be another money trap through your business and the collateral assets and the legal troubles that it requires. Don't get blindsided with interest rates or rejection letters, and do your homework. So let's talk about securing your loan and getting approved. With so many factors involved in the loan process, it's hard knowing exactly what to focus on to be approved by a bank, which begs the question, how can you make yourself seem like the ideal loan candidate? Here are 8 tips to help you secure the loan that you need. Number 1, open a business card. Arguably, the most important factor when looking to secure a loan is to have good credit. Just like you can build up your personal credit through a credit card, so too can you do the same for your business. Be sure to get your business credit long before you need a loan, as opening a new line can negatively impact your credit score rather than improving it. If you'll need a loan within a few months, it may be better to hold off on establishing a business credit card until after you have secured the funding that you need. If you have time before a loan is needed, gradually increase your business credit score by opening a credit account and use it consistently each month for simple, reoccurring payments that won't overcharge, being sure to pay it off in full and on time each month. Number 2, finish your forms. Surprisingly, the number 1 reason why loan applications are denied is because the application form wasn't completed fully. So be sure you take the time to not only fill in all the blanks, but get your financials in order and bring in the right paperwork. Number 3, gather references. Though it's not usually a requirement, a great way to help your application get approved is to have a lineup of references speaking positively about your business and your reputation as an owner. Acceptable sources include clients, vendors, colleagues, and business partners. Maintain your personal finances. Many lenders look at the state of your personal finances as well as that of your business, so make sure that you have a good credit score, no late payments, and avoid maxing out either your business or personal credit cards, as it lowers your score. Number 5, make a good impression. Appearances can go a long way when it comes to getting approved. Something as simple as a clean website with a good About Us page, professional responses to both positive and negative reviews, and a vivid online presence can help a lot. Another tip to show you're serious about your business is to consider making it an entity such as an LLC or S corporation rather than operating as a sole proprietor. Number 6, increase profits. As any lender looks to be repaid, a strong show of profit is crucial for approval, so be sure to follow up on invoices shortly before meeting with a bank, or even offer clients discounts for advance prepayment. Number 7, decrease expenses. Another great way to increase profits? Cut down on operational costs. Look closely through your monthly statements and search for any unnecessary subscriptions. Research more cost-effective equipment. Explore alternative payment options for your vendors, like offering discounts or a trade, or even break up large payments into smaller monthly ones to make your finances look that much better. And number 8, don't stop at 1. Here's the thing, not all lenders are the same, and not all have the same priorities. What could be seen as a risk for one bank could be acceptable to another. So if your loan application gets rejected, try again. There are plenty of loan options out there, and quite a few lenders who might be willing to give your business a chance. Your job is to simply try your best and choose the right one. I hope you found this discussion helpful. I know this is a lot of information, and I have some links to blogs I've written on this topic in the show notes. Be sure to check out the details if you'd like to review again, and be sure to download the episode to be able to refer to it again in the future. Thank you for tuning in today. Would you please share this episode with those you know and leave a review on your favorite platform? And if you find our show informative, would you consider being a financial sponsor to help me continue my mission to educate business owners? A link is located in the episode description, and no amount is too small. I'd really appreciate your support. If you are interested in connecting with our guest and receiving the offer they had to share, a link to our resource page is in the show notes. Finally, if you have any bookkeeping or payroll needs, reach out to us at 310-534-5577 or contact@abandp.com. My team and I are eager to assist you. Until next time, have a great day.
Thank you for listening to Biz Help for You. Please join your host, Candy Messer, again next time. Have a terrific day.